Hello everyone, I am Ankit Kanodia, founder of SmartSync Services, a SEBI registered investment advisory firm based out of Ahmedabad. Welcome to the 21st episode of Mission Smile Investing Karwa. For those who are joining or watching for the first time, Mission Smile stands for Making New Stock Market Investors Learn It Through Engaging Research. And Investing Karwa is an initiative where we call investors from the industry and learn from their rich experience in the stock market. Speaking of investors, we have one with us today, Mr. Niteen Dharmawat. Thank you so much, Nitinji, for agreeing to do this.
Thank you so much. It's my pleasure.
So I'll just give a brief intro of Nitinji. So Nitinji started his equity market journey 30 years ago as a hobby and ended up pursuing CFA from CFA Institute, USA. He's a CFA charter holder and he brings in rich industry background and that helps understand companies, complexities of business and tipping points. He has worked with leading groups including CRISIL and L&T among others. Nitinji believes in going beyond numbers crunching. He focuses on the long-term value investment ideas with sound fundamentals, the business operations, strategic direction, the competitive landscape, the governance process, the background of the promoters, to name a few. He believes that often these are more critical items than just numbers crunching. Nitinji has, to his credit, several multi-baggers, and also he has identified many fraud companies much before they got bust, and that helped investors. So without wasting any more time, Nitinji, I welcome you once again, and we will straight away join in or dive deep into the experience and your learnings over this 3 decades. So I'll just start with the very basic question which I ask all my guests. Let's start from the beginning. As in, if I know you well, you started investing somewhere in the 90s. Some of our participants today were not even born then. I was probably in the 4th or 5th grade. So tell us about it, how it all started. And before entering the investing field, what were you doing? You're muted.
Yeah, thank you so much again. Am I audible now? Perfect. Okay. And you want me to speak only in English or Hindi, English, and Hindi?
Dil se boliye. Hindi, English is not a problem.
Perfect. No, I'll continue with English because most of the participants may come with the background where they may not be able to understand English, but in between, if it is required to communicate, we can do that as well.
Yeah.
Okay. So it all started actually in early 90s. Those of you are aware of there was a Harshad Mehta scandal which was going on during that period, and little prior to that, in late 80s, there was an IPO of Reliance which came in the market. Okay, and my father applied in that IPO. And he got some allotments. In those days, IPOs were not as difficult as they are today in terms of allotment. He got some allotment, and then as a kid, I started, tracking prices of that company, and slowly and gradually, my interest actually started building over there. So every Friday in that newspaper, local newspaper, they used to cover one summary about the market during the week. So Friday or Saturday, if I am not wrong. And I used to read that. It was little difficult for me to understand anything out of it. But slowly and gradually, after a couple of months, I realized that I am able to understand some term. I have got some familiarity. As it happens, even if you are not formally educated to that. So that happened. And then early 90s, as I said, that was the period of or era of Harshad Mehta scandal, which we know now in hindsight that it was a scandal, scam, but it attracted a lot of people. So what happened that during that period when I used to go to my college, stock market building was on my way, and I saw that so many people are standing below that building. I didn't realize why they are standing. And after a couple of months, I realized that I am also a part of that big group, and started doing something over there. And that start was not great, because eventually when everything got burst, I lost good amount of money in that. But there were many learnings out of that, and one of them was, never get swayed when a lot of bullishness is there in the market. Be very careful about the industries which are doing exceptionally well, because there will be a lot of stories. Be very wary about the reports that you see in media, whether it is electronic media started a little late, but print media, electronic media now, or now social media as well. So you need to be very careful about this. So those were the learning. And then after year 2000, my father actually encouraged me a lot during that period. And he asked me, and he never discouraged even if the loss, because loss was my father's money, not mine, because I was not earning. And he encouraged me to learn about it rather than getting swayed by the market. So after year 2000, I started focusing on learning fundamental analysis. I got some good books, and during that period Kindle was not there. Those books were not available in India, but I came to know, for example, security analysis or intelligent investor. So these were the two early books which I read. I got them from USA. I was in job by that time, and one of my friends was traveling back, so I got those books. And then it helped me a lot, and slowly and gradually that interest, building up. And then by 2008, I started, conducting free investor education session, because I felt that it has to be given back to society, because there are a lot of people who helped me in learning. So for almost 10 years till 2018, when we started Aurum, and my time got divided, we conducted almost every month those meetings in Pune, and that helped me reaching out to many people. And this is a small journey with lots of ups and downs.
No, it was very interesting to know, Nitin ji. So I have a few follow-ups related to what you just mentioned. So I just wanted to understand, how did you pick stocks at that time? As in, was it just based on tips, और जो हर्षद मेहता ले रहे थे वो आंख बंद करके ले लेने का, वो नीचे तो जाएगा नहीं, या whatever? Because I want you to share it so that new investors should know what is the general mistake which even people with good experience actually end up starting their journey in that way only, right? And but still they learn and evolve and harness their process and become a better investor. So आपने स्टार्ट कैसे किया था, वो थोड़ा बताइए.
तो क्या हुआ ना, बहुत सारे केसेस में जब आप मार्केट में अर्ली स्टार्ट करते हैं, और स्पेशली व्हेन द बुल मार्केट इज गोइंग ऑन, you get swayed by the amount of energy which is there. Okay. And not necessarily all from the tips coming in from what Harshad Mehta was buying. I'm not very keen in that, but I was more keen in making quick short term money. Okay. So say for example, if I bought a share and say 100 shares, okay, and I felt that if it goes up by 10 rupees, 15 rupees, I'll sell and make 1,000 rupees, 1,500 rupees, that kind of quick money. But and without having any understanding about the business, the financials of the company, the promoter of the company, the background of the company, the products of the company, the opportunity size, nothing actually. So it was more of hearsay kind of investment, wherein you want to make quick bucks, but ultimately you realize that market is very smart and will eventually take everything out from you.
Right, right. So I'll now come to the second aspect which you briefly touched upon in your early introduction, is that you mentioned that you were not earning that much. and you basically started investing with your father's money. So I'm just trying to share how paranoid I am. So I could never even think of putting my dad's money. And अगर डाल दी होती और मेरा पैसा डूब गया होता तो I wouldn't probably have the confidence to even go back to the market. So how did you gather that confidence, and what were going through your mind? Because that is very important, because we are all differently built, right?
Yeah. So I think a lot of support was there from my father. He never ever said anything to me. Never, actually. It was a very substantial amount, but he never discouraged me. That was a good point. In fact, I had to discontinue my education for a year. Something like that has happened, and then I restarted. And he motivated me a lot, kept me, encouraging me. So that is how the journey continued. And when year 2000, when IT boom was there, we never actually participated in that, because I realized that those kind of mistakes should not be repeated. If everybody is talking about a sector, everybody is talking about an industry which is going to make a lot of money, which is going to work beautifully, we never participated in those companies, because ultimately you may end up again with the same cycle of quick bucks, and that quick bucks never work, and you may end up paying significant prices.
Yeah. So another point you mentioned was that your mother also encouraged you a lot to learn about markets. Again, I refer to my own scene where when I told my parents that I want to make a career in stock market, both of they were actually scared and worried. कि ये बंदा क्या करने वाला है? Stock market for them was always a jua. But I just want to understand, how can your mother, so was she educated enough, or she used to do trading or on her own as well, or what was the reason you think she encouraged you or motivated
Uh,
you?
So my mother was a simple housewife person, and she was not participating in market, but she was neutral, always neutral. She never said anything to me. And my father was more, because he was aware about the market, the opportunities which are available, and things which could make difference. So that is how it worked. And you rightly said that as parents, a lot of encouragement may be required, and people may not be aware of. For example, after I got married, ससुर जी बोले भाई ये स्टॉक मार्केट मत करो आप, उनको तो डर लगने लगा जब उन्हें पहली बार पता लगा कि आई एम इन स्टॉक मार्केट ऑल्सो. तो ही सेड दैट ये सब मत करो, ये सब सट्टा है, इसमें अपने को पैसा नहीं बनता है, नुकसान हो जाएगा. So it is the same kind of feeling which will be there. So and nothing wrong in that. He wanted to be careful about us. He cares, so that's why he was saying. And people may not be aware of, but later on he realized that it is not that way. In case you understand the risk that you are taking, and the kind of there is a systematic process. So if you go through it, then it is not satta. Otherwise, it is definitely satta bazaar.
Right. Coincidentally, in my case, it was just the reverse. My dad was paranoid, and my Sasuji was always encouraging. So when he got to know that I am investing in the market, he used to always motivate me. No, no, you should do it. And later on, my dad also, when he saw that there is a system and there is a process, it's not a satta bazaar or something like that.
Correct.
So then he also eventually understood the merits of the market and investing. So now moving on to the next question, Nitin bhai. What made you believe that this is where you belong? As in, is there a specific incident or a series of incident or accidents that charted your life this way, or it just happened to be like this?
So it maybe a destiny was written. Okay, because when I came early in the market, I realized that this is the place where, since we all come from middle class background, okay, and we have our own aspirations, and very early I realized that this is the place which could, change the course of our life. Even if I lost money, I was still clear that this is the place which will eventually change our destiny. So that is how it worked. In fact, I was not too sure if I'll make career in stock market, because after 92, 93, the market was not doing really well. So till almost 98, 99. So there were a couple of years of downturn. Nobody was prepared to go and take finance as a major, or was forthcoming in making career in investment. So that kind of downward cycle was there, so nobody was thinking about it. And after 2000 again, the same thing has happened, 2000, 2001, and then 2003 onwards again the different cycle started. And when I was in industry, I was working in software companies. I saw how, after 9/11, that burst has happened in IT companies post that. Actually, it started slightly before that, but after 9/11, it was significant. And I saw, people are, and this industry was very nascent. It was growing, and it actually employed a lot of people, and it was offering handsome salary compared to other sectors. So a lot of encouragement was there for people to come in this industry, but that industry itself was at risk during that period. So I thought that it is better to develop another skill, and slowly and gradually I started working on that, since this is the another thing that I knew, and I thought that I had to make if I had to make career, then this will be the industry.
Right. Right. So basically, you have shared how you were swayed by the market and other heroes of the market at that time when you started. But I'm sure after, as you said, that you read a couple of books by Mr. Graham, one being The Intelligent Investor and then the other being Security Analysis. So I would assume that immediately you would have started taking that value investing principles, wherein you try to focus a lot on the downside and focus more on the price which you pay before. I am sure regarding the quality of business or growth, or the how long the business can sustain, that would not be the main criteria when you would have started up just post 2000. And then over the years, you would have probably understood that as well. So how did that shift happen? How was the whole journey? Can you give some examples, as in where you bought us maybe a very cheap stock, but later on realized that it was cheap for the good reason. And maybe sometimes you had to probably pay up a little for a good quality business, and how this transformation happened over the years.
So there are a lot of things actually, because that process gets matured over a period of time, as you rightly said. It doesn't happen on day one, and then you realize what suits best to you. Okay, there can be some experiences where you make an investment, it doesn't work, or some investments which you declined, but they have given fantastic reasons. Those kind of, error of commission, error of omission will happen, and it happens, and then slowly and gradually you develop and get matured as an investor. And that is the same journey I have gone through. For example, in 2004, 2005. I bought one. I started looking at this tile and granite, those kind of companies. So I bought one company. It was around 50, 52, and it was cheap. Okay, based on all the parameters that I used to look at during that period, and then I realized that it is not working. After 6 months, 8 months, 9 months, 1 year, 1.5 year, I realized that it's not working. And then I had to shift to something else. Why it was not working has to be analyzed. So it was not working because there were issues in terms of perception about the quality of the promoter. So that's an important lesson, that promoter quality has to be very high. If you are discounting that, if you are not putting weightage on the quality of promoter, even if stock is cheap, it may remain cheap, or it may become cheaper. So it's better to avoid that. So that became a basis that governance has to be very, very strong in the company. So that's a one basic hygiene factor. It has to cross for every company before we start looking at other parameters. So it has happened something like that. Or maybe in 2011, and I quoted this as one of the mistakes, wherein I bought one stock and I was not able to connect the dots eventually. And I was lucky that I made finally some decent money in that. But had I, connected the dot in that, I would have stayed away from that company. That company was MCX. So there is no recommendation right now, because I am talking about a case study from 2011, if I'm 2000, not 11, 2013-14 period. So I bought that about a year back, if I'm not wrong, and it was at around 1100 or so. And during that period, there were at least two brokers who approached me for investment in their unlisted entity, which was NSCL. Which was their warehouse where they used to keep the all the inventory, and they were saying that you'll make decent money. And I questioned them that if you are offering me 14-15% and there is a commission to you maybe of 4-5% and 2-3% that company is keeping, then this must be 21-22%, and that period was very difficult for the economy, and you are not going to make money. Okay, so there is something wrong which is happening over here. So I stayed away from those investments despite they're offering very decent money. And M6 was very strong, exchange at that time. Even today also, they had significant market share. They were the largest. So it makes case for investment even in those unlisted companies or in their bonds which they were giving. But eventually what I thought was right, that there is some problem. And later on we came to know that there was a scandal over there and that got busted, so it impacted MCX also. Okay, so that dot I should have connected, that if something is going on in the subsidiary, it will eventually hit this company as well, which is again a learning which I missed. And stock came down from those 13, 1400, 1500 levels to all the way to 200, 250. I bought some more towards the bottom, and eventually made some money. But having said that, that's not important whether you made money or not. Your process has to be very strengthened. You should avoid such mistakes wherein you see something, you conclude something, but you need to connect those dots with something else also which could happen in the companies.
Right. So since you talked about promoters and governance, so I'm reminded of my fortunate meeting Mr. Nimish Shah of Inam Group. I met him for just 5 minutes. I was in the Flame University attending one of the courses of Professor Sanjay Bakshi, and I knew that I just have 5 minutes, so I just asked him, "Sir, what one piece of advice would you give to a beginner like me?" So I just started my career as an investor. 2-3 years, 4 years हुए होंगे ज़्यादा से ज़्यादा. So he said that I'll give you 2 advice, not 1. So he said that first of all, never get into that dogma that this is not the right time to invest or this is the best time to invest. Any time is a good time to invest, provided you have a long-term horizon. Of course, there will be ups and downs. Maybe if you start somewhere around 2017 when the market is probably at the top, next 2-3 years could be difficult, but you are not putting all your wealth in 2017. And if you are a beginner, there is a high chance that you will end up making more money through your other efforts and will be able to put in more money during these down phases. So you should not be worried about all these things if you have a long term. That was his first advice. And second advice was that while in the USA, it is first business, then promoter, and then finally price. In India, you have to start with understanding the promoter first. So, and I think you alluded to this point in the previous questions also. So, he said that however great the businesses can be in India, it is not, sometimes it is not worth even looking at if the promoter is not going to treat the minority shareholders fairly. So now my question to you is, and I'm assuming that you understand what I'm going to ask you now, is what is your view on the same? And can you expand with a few, you have given a few examples, and can you probably give a few more examples? Because अभी जैसे bull market चल रहा है, there are a lot of dubious promoters also who are making good money out of the current rally. And many new investors, all they are looking at is how the stock price is moving, how they are making money. And you made a very, very pertinent point that it is not just about making money, it is about the process, because you might be making money in this bull run, but if you don't sort your process right, then probably in the next downturn you will lose all what you have gained. So थोड़ा लंबा question हो गया, but I hope you get the gist and maybe expand on this now.
Yeah, sure. So first of all, it is very difficult to comment for a legend like Nimish Shah sir, and his advice is absolutely dot on, absolutely dot on. First is, as you said, that we need to have a long-term view. Okay, and every time is a good time to invest. Yeah, if market is towards the top, maybe you can stagger your investment if you are fearful about the risk. But businesses have to be evaluated on an individual basis. So that's first. And second, he talked about the first in India, you have to evaluate companies for the promoter quality. A very significant, very important point that Nimisha sir said. And that actually differentiates what we read from books provided from USA, and then what you practice in India, because practicing in India is absolutely different. Promoter quality and integrity may be given in USA and most of the companies, but here you have to evaluate that. You have to understand whether the promoter is going to deliver, or he's just talking, or he's bluffing, or ultimately he is going to take all the money from you. So very, very important. I'll just add one more point to it, and I'm sure that a very significant point is about the behavioral aspect about investing. And what he said in the first point, actually it is linked to that, so that I'm elaborating his first point, is to have the behavioral control on our investment during our investment journey. We should not be too much worried when the market is going down, that there is a correction over there, and we should not be too enthusiastic in putting our all the money when the market is very heated or sectors are very heated. And there are multiple examples to it. And I quite often say that people do not lose money in bear market; they lose money in bull market. This is based on my experience. They never lose money in and in bear market. In my experience, I have not seen people losing something they bought during the bear market. Even if those companies were not great, they will still make good money. But people can lose a lot of money in a soaring bull market, and it happens because you end up paying significant premium during that period. So let's start with a good example from 99 2000 rally in IT companies. A very relevant example is there. The market size of IT company was significant, as we know, after 25 years, 25 years after that bull market, the companies have grown multifold from that period. And there were many companies trading every day. Huge volume used to happen. Okay, many of those companies are not trading anymore after a couple of years. So people lost almost 100% of their money in those companies. And generally what happens that people say that let's put up stop loss. It's very difficult, because if you have put a stop loss, say for example 20%, they may come down 20% in the next 3-4 days, and then they may start again journey. So what will you do? So that's the problem that investor could face. A trader may have a different view, but if an investor is there, then he should be very careful about this. So and if you look at some of the good companies, so there are many companies which died eventually, but there were some good companies. For example, and there is no recommendation again. For example, Infosys. So Infosys valuation in 2000, and we have seen that over a period of time it has done phenomenally well. Promoter quality was good, opportunity size was fantastic, and company has done phenomenally well in terms of profits over a period of time. But those valuations which were there in 2000 came after several years. So if there was a correction because you're paying significant premium, the P's were, in excess of 150, 200, 300. People are saying that, these companies are growing, they'll make a lot of money. They made a lot of money, but investors did not. And it is the quality of the bull market. It sucks everyone. And eventually you could lose, your time value even if you are in good companies, and you would lose everything if you are in bad companies during that period. So you need to be very careful in putting new money, fresh money during the bull market. If you are already holding, there is no problem. So then you can cash out of eventually from those investments. But if you are making fresh investment and if something goes wrong, the price can be very significant.
Yeah. So that's a very good example, Nitinji, what you mentioned. I was just, while you were speaking, I just quickly checked. So if you would have bought Infi at that time, even after holding for 25 years, you would have made just a 5x, which would be, I think, a single digit CAGR, or
Absolutely.
maybe 10-11% CAGR, something like that.
And you look at the growth in their profits.
Exactly. Look at their growth in the profitability, the volumes, as in the size of the earnings, size of the cash flows which they are producing, and the kind of market capture they have done. But despite that, in 24 years, it has probably given 10-11% CAGR. That's it. So that's a very important point. So another, while you were saying this, another thing which came to my mind is that I think all bull markets, you talk about the Harshad Mehta bull market or the IT boom or the 2003 to 2007 real estate boom, or maybe small cap and micro cap mania during the 2013 and 17 phase, or maybe the current bull market which started post-COVID. But I think there are many things which remain the same, and there are always few things which are different. So since you had the chance to look at so many cycles, I would like you to just point out a few things which always remain same, and also point out a few things which change from time to time, so that our viewers can get some perspective as to how you should approach a bull market or how you should approach different cycles based on your experience.
So what remains same is, the behavior of the investor. Okay, and not necessarily the retail investors. This could be, institutional investors. This could be very qualified, experienced investors. They can also get swayed by soaring bull markets, and it happens because it sucks everyone. It has significant energy when the prices are moving up rapidly, and you have FOMO, fear of missing out. It creates a lot of pressure, and it's not easy to handle that. It's not at all easy. Those who are able to handle, they make a lot of money in long term, and that is what we have seen. How maybe Warren Buffett would have done, or some of the investors, great investors from India would have done or have done over a period of time. So they avoid that. So handling FOMO is very difficult. That's why I said that, bull in investment world is always associated with green color. Okay, and beer is always associated with the red color. So and whenever we see green, we start feeling that, it is great, it is significant, it's positive. So a lot of positivity is associated with that green color. When we see, our portfolio moving up in green every day, we start having a very happy feeling in our mind, and we may end up actually spending money out of pocket for buying certain things, or maybe enjoying traveling, even if we have not booked a real profit, just because it gives you a feel good factor when you see your portfolio getting into positive territory. On the other hand, when it is red, it is associated with negativity, with with maybe a depression kind of situation. If it is extreme red, then you may continued red, you may close down everything. You do not want to see your portfolio also. While when it is green, you may like to see it every day or maybe every minute, that how it is moving. But opposite happens. Now to handle that pressure, you just reverse this situation. You start feeling that if it is green, it is not good. If it is red, it is very good, it is positive, because it is giving you an opportunity, it is coming down. And that's where you will be able to make money. You will be able to buy certain things which you always wanted to buy, and they will be available at a lower price. So had you avoided Infosys in 2000, and instead of that, if you had bought Infosys in 2003, look at the return. The returns will be significantly different, okay, just because of the gap of 3 years. Okay, 2 3 years. And why? Because the prices have come down significantly, and then it gives opportunity. So that is something that I've seen that it has not changed. What changes in every bull market is two things. One is every bull market will have a different reason, or a different industry to cherish. So 95, 96 finance companies, did really well. A lot of other companies also did well because of the scam which has happened. But especially small finance companies got listed, and they raised a lot of money. Or year 99, 2000, IT companies did very well. So different kind of bull market. Or 2003 to 2008, as we know, real estate and infrastructure, those companies did really well. So different bull markets will have a different sector, new sectors getting emerged. So that's one thing which is very, very common. It has not changed. It will happen the same way. And the second thing which has not changed is the end of the bull market. Okay, the reasons will be different. Okay, so that has also not changed. So every bull market will end for a different reason. So 92, 93 bull market ended up because we came to know about the scam. 2000, 2001, and market will find its own reason, okay, which you will be able to appreciate once you know. Since the prices have gone up significantly high, there will be a reason to have that bubble burst. And reasons market will find, as I said, on its own. So 2000, 2001, 9/11 happened, and then everything got corrected. Or 2008, 2009, we know financial crisis happened. So again, a different reason. So every bull market will have a different story or different reasons to correct. But one thing which we need to be very careful, or we need to inculcate that as a behavior in our investing journey, is to reverse this position of looking green as negativity, and red as positivity. So if it is going green, then I need to be very careful, sensible. It should not happen that I start getting very affected by that green color. And I should be more concerned if valuations are moving up, and may look for booking some profit in case I am already invested in those companies. So this is something which has changed or which has not changed.
Right. So when you were mentioning about the red and the green thing, all I was reminded about was the Matrix movie. So we should look ourselves like Neo and bite the red pill rather than the green pill over here. So before moving to the next question, I just want to correct myself. I said that the Infy stock became 5x, but it actually became 10x in the last 24 years. But when you calculate even the 10x performance, the CAGR comes out to be about 10%. So, and as Nitinji rightly said, that if you would have bought Nifty, say 4 years later or 3 years later, at significantly lower price, you would have made 50x in 24 years.
Wow. Even I was not knowing that. And my guess was there, because if it is a correction, you'll make a lot of money in good companies. So wait for that, and never lose that opportunity, because it is red, you will not be having a courage to buy. So even if you have not made 50x, if you end up making 30x, 40x, it will be significantly different from what otherwise you would have made.
So I have a follow-up question to this, Nitin ji. So this is a very important point, and I think at some level all investors know about it. It's not that we don't understand, but I think market over the years keep making it more and more difficult for us. For example, say in 2003-4, you had the luxury of getting say Infi at less than 20 times earnings, right? Or something like a Nestle or an Asian Paint at 25 or even 20 times earnings. But each 5 year, 10 year, when we look ahead, what we see is that the average valuation of the good quality companies is going up and up and up. Just to give an example, I don't hold the share of this company. Look at DMart, for example, Avenue Supermart. So even I vividly remember when the IPO came, we all knew such a fantastic company, such a fantastic promoter, what kind of pedigree, how important it is for the consumer. But even at the time of IPO, an average investor like me would have thought that it is very expensive. Let's wait for the price to come down. And it never came down. So what would you say on this aspect of every successive 5 year, 10 year period, market is becoming more and more expensive. So an average single digit P, which was easily available for even good quality companies at bad timing or bad cycle or bad industry position. Now it has from then in the next decade, it moved to say 15 times. And now it would be somewhere around 25 to 35 times, right? So how do you deal with that?
So the my take on this would be the cycles in the market. Okay, so there is a business cycle, there is a market cycle, there is an economic cycle. Okay, and this cycles may behave differently during different period, but over a period of time they may converge, and when they converge there can be disruptions in one of the sides. For example, economy may be doing well but market may not be doing well. Okay, or businesses may be doing well but market is not rewarding them. It happens. Okay, and sooner or later market realizes that. So I have to be, as an investor, I have to be very careful about what price I'm paying to buy those businesses, and I have to buy when nobody is interested in those businesses. We call it buying the pessimism. Okay, so if there is no interest in those companies, I would be definitely interested in looking at those sectors if they are not going to be disrupted permanently. So if they are not getting disrupted and the companies are going to survive that downturn, you can make a lot of money. And since you talked about some of the companies which were trading at a lower P and they are trading at a significant valuations. Not only that, if you compare with some of the companies which are whose parent companies outside India are trading at a discount compared to what these companies in India are trading at. Primarily because the good businesses or the good promoters maybe in short supply. So that can be one of the reasons why good promoters will start getting significant premium. Second is there can be a market cycle wherein these companies or these sectors may be in demand. So we have to be little sensitive about these factors before we making our investments in those companies.
Right. So I'll move on to the next question. So basically, leading up to this session, I watched both of your CFA presentations. One was titled Buying the Pessimism, which you just alluded to in the last question or answer. And the second one is how to avoid common mistakes and uncommon losses. I think this how to avoid common mistakes and uncommon losses is probably inspired by that Philip Fisher book, Common Stocks and Uncommon Profits. And I'm sure many of our audience have also watched both these presentations. However, for the uninitiated, it would be great if you can just highlight or summarize the key takeaways And again, a few stories or examples, because that is where we learn the most. So if you can just share a little bit about both the presentations at CL.
So yeah, so in fact, those presentations are very close to my heart as well, because uh, they summarizes what my investment philosophy is. For example, the first one, which is uncommon losses, uh, is all about, how do you identify the issues in the company, and if you can keep it very, very simple. Okay, so what I've seen, that companies do not survive primarily because of two reasons, or maybe you can add one more, three reasons, but primarily two reasons. One is excessive debt, and second one is cash flow. If your operating cash flow is not positive, and I'm not talking about financial companies, because financial companies work slightly differently, because their raw material is capital, and they borrow from the market. So operating cash flow can be negative in those, and will be negative, not can be, but will be negative in financial services companies, banks, and all those. So excluding them, if you are looking at manufacturing companies, or maybe services companies, the cash flow has to be positive, and that has to be manageable. If companies are great, the businesses are great, but if you have excessive debt, and if God forbid cycle changes, you will be in trouble. And if you are not able to service those debts, the impact will come at the door of equity investors. Because equity investors, if you make a line, equity investor will be standing in the line, in the last in that queue. Okay, so he will not be getting anything out of that company in case there is an issue in servicing the debt. So it has to be very, very important that we look at the manageability aspect of the debt and cash flow. These are two very significant points. And if you add third one, which is the quality of the promoter, because if the quality of the promoter, because that I said, that is the first one, it's the basis, the quality of the promoter. If the quality of the promoter is not good, obviously the debt and cash flow can have a problem, and most of the cases will have a problem. And if somebody is very aggressive in growth, you need to be careful about those companies. So that's first one. And the second one is about the buying the pessimism, is all about just reversing the position, which I was talking about a little while ago, is looking at red as green and green as red. So if you take an example of 2020 post-COVID period, 2020-21 maybe, and there are multiple case studies which I covered, and I'd like to highlight one, which is from tours, tourism, and hotel industries, especially during second wave around April. And this was a very, very difficult period. Some of us must have gone through personal losses also during that period. But if you look at these companies which were dealing in tourism, tourism was dead. Nobody was going to hotel. They were all inside homes. We were all scared what will happen, whether we'll survive or not. But if you look at rationally, if you are going to survive, and uh, and uh, uh, and these companies, if they do not have significant debt exposure, they'll make a lot of money, because many others will not. Okay, so if you look at rationally in that industry, without getting too much worried about the short term implications, because everything is red. And I tweeted about it, I talked about that industry extensively without naming stocks. uh, uh, I was very clear that you'll be making a lot of money. So if you look at 10 companies, basket of 10 companies, if you are not clear, maybe one or two or three, if you divide your money in those 10 companies, that basket is up 8 times from 2021 in just 3 years. Basket. Some of the companies have done much more than that basket. So that kind of money can be made if you are buying the pessimism, but it requires courage, it requires long-term outlook, and it requires a lot of patience.
Oh, thank you so much. That was very, very, very helpful, Nitin bhai. So I'll move on to the next question. So it basically is related to the title of the session today, which is value investing voyage. So I think there is no debate that there are multiple ways to invest in the market. But I wanted to ask you, why did you pick the path of value investing? Why not growth? Why not BAP, which was very famous at one point of time. Why not momentum? Why not technical based trading? Because you, having been in the industry for 30 years, you would have been exposed to all these kind of style of investing. What made you choose value investing and not others? And for the benefit of the audience, what according to you is value investing? Okay, is it only
So,
because of price, to focus on the price, or there is more to it? Yeah.
okay. So, first of all, when I started my journey, there were not too many, terminologies like we have today. BAP, momentum, all those were not there. Primarily two, actually, I remember it correctly: fundamental analysis and technical analysis. These were the two. And within fundamental analysis, you can have growth and then value kind of, philosophies. Uh, and I thought of technical analysis also, but eventually I realized that that is something does not suit my temperament. So you evolve as an investor over a period of time, and you have to see that what suits you and your thinking. And I am someone who would like to, who loves to evaluate businesses, who would like to read about businesses, about the companies, going deep into the companies, and that is something which is primarily available in fundamental analysis. Now, between fundamental, you have value or growth. I don't give too much weightage to it, because if I'm looking at value, then it has to be, the growth has to be at a reasonable price. That is very important for me. Otherwise, you end up paying a lot of price, which I explained it in 2000. These companies have done significantly well in terms of their profits or revenue growth, top line growth. Companies like Infosys, they've done phenomenally well. So growth was there, but the value that you paid for that price in 2000 was not something going to reward you over a period of time. However, if you just wait for a few years when the prices got corrected, you can make a lot of money. So I am, see, ultimately my funds are limited, my resources are limited, and I have to allocate them. So I allocate them based on the value which I am getting for the, and the price that I am paying, okay, against the price that I am paying. So, and what is value for me? Value is something, if I'm paying something, what say for example, if I'm buying a house, and I believe that it is worth 1 CR, and somebody is asking 1.5 CR. I had to wait, or I had to look for some other options. Okay. Similarly, for companies, then there are different ways to valuing the companies. Uh, so if I'm valuing a company, and if the stock price should be 100, and if it is trading at 120, 150, 160, better to wait for those prices. If they do not come, like as you said, for the retail company which never got corrected to the price that from where it started, it's better to lose those opportunities, because you have certain process set, and you won't like to contradict those processes, because you may end up making losses somewhere else, and those losses can be significant, because if you start compromising on your basic philosophy, which is value driven, and if you start paying excess because you feel that this company or this promoter is great, of course they are, and they might have done well also, but losing those opportunities, I'm still fine, because I may end up paying significant price somewhere else if I start compromising those processes. So I'm very clear about that, that certain things I'll not do in the market, and that is the starting point for me. Okay, so as rightly said by Charlie Munger, all I want to know is where I'm going to die, so that I don't go there. So those things will give you the list of doing certain which you will not do. Okay, the things that you will not do. So I'll not do trading. This is not suitable to me, my mindset. I'll not do F&O, because I believe that this is not built for retail investors like me, and losses can be very significant over there. And ultimately, I'm here to make money, not to lose money. and I'd like to avoid all kind of risk, because already risks are there. Market risk is already there in the market. I'd like to avoid that. I would like to avoid shady companies. I would like to avoid paying excessive price for the companies. So those are the, some of the things that that is a list of what I am not going to do in the market.
Right. So, if I understood your philosophy well, I think as you rightly mentioned that you will end up leaving a lot of even good companies where you know that probably the stock price will do well for some time, but because it doesn't fits in your value philosophy and you don't see the margin of safety while you are buying the stock, then you will give it a pass, right? So it is like just for the sake of simplicity, I'm just trying to give an analogy of you driving on an highway and you have decided that I'll drive at 80 kilometers per hour. There will be many cars who will overtake me and go at 100, 120 speed. They might look very attractive, but there is a high risk of an accident. With maybe not all cars will face accident, but there is a high probability that few of them might meet an accident. So that is what you're trying to protect. And if you're driving in a speed which you are comfortable with, like in your case, value investing is your style in which you are comfortable, there is a higher chance that you will continue to drive smoothly, not only in the park, but you will also reach your destination on time. Right.
Yeah, absolutely. So I am not too much worried about the excessive return that I'm generating as against others, because if I'm doing that, I'm again in that that circle of FOMO, okay, fear of missing out, and I would like to avoid that. I'm happy about other investors if they are making money. I'm happy if I'm selling something and it going up. I wish best, and I always want it should go up, because if somebody is buying from me, he should also make money. So I'm not that greedy, absolutely no. Because if I start becoming very greedy, I'll start making losses, because I never know where the top is. So I'm happy if they are making money. I'm happy if other investors are making money. What I am comfortable with is to pay reasonable price to avoid unnecessary risk in the market, and then make reasonable money over a period of time. If you take a simple example and I'd like to cite, which is very important example, especially for newcomers, and I quite often cite that it was highlighted in one of the Parag Parikh Mutual Fund newsletter also. If your great grandfather around 200 years ago left 100 rupees for you, and he said that, okay, after 200 years I'll have somebody in my family named Ankit, okay, and I'd like to leave those 100 rupees for him with two conditions. One is that I'm investing in some medium where it is generating 10% annualized return. Okay. And second condition is nobody should be able to withdraw this money. It will be compounding over a period of time. Okay. So just 10% return. How much will it be after 200 years? And any guesses for that? Let me not put you at odd situation. Let me give the answer. It is around 1900 crores. That 100 rupees in 200 years, and I had taken a very long period, because the compounding effect can be explained with this example. Just 100 rupees, 10% annualized return over 200 years will become 1900 crores. Now, just a small change in this story. Okay, when your great grandfather left 100 rupees with those two conditions, there was someone, your great grandfather, after 100 years, another grandfather after 100 years, exactly after 100 years, he came and he found out some way of withdrawing that entire amount. Okay, he said that, okay, Ankit will come after another 100 years, so let me withdraw this corpus and use it for some time, and then I'll reinvest it. So what will be the worth of that 100 rupees after 100 years? After 200 years, we know it is around 1900 crores. So after exactly 100 years, what will be the worth of that 100 rupees invested at an annualized rate of return of 10%?
I would assume it would be less than 100 crores or maybe 100 to 100 crores, something.
You will be shocked, Ankit. It is 13 lakhs.
13 lakhs.
So 13 lakhs. So first 100 years, 13 lakhs. Second 100 years is, everything get accumulated. So 100 rupees become 13 lakh. 13 lakh becomes 1900 crores
1900
in
crores.
next 100 years. So that is the impact of compounding. So I'm not worried too much about who is making what. I had to, do my work and let everything be left on compounding on the market. If my process is right, eventually I'll be there. Even if I'm a tortoise, I'll be there.
Yeah, but on the flip side, many investors, specifically investors of current generation, will say, who is going to live for 200 years? We are of the YOLO generation. You live only once. So what is the takeaway for us in this kind of story? So that is the another
You
side.
reduce the period. So I had taken a impractical example. You're right. Actually, 200 years nobody is going to leave. You reduce this the period. The impact of compounding will remain the same. You reduce it
Exactly.
maybe 10 years and 20 years because that is the period you are likely to be there. So impact would still be similar. The first 10 years may be different. Second 10 years will be absolutely different.
Yeah, we have a very good example in the form of Mr. Warren Buffett. So everybody knows that 99% of his wealth has been generated after he attained the age of 55 or 56. So,
Yeah.
so all these are very good examples of the only problem. See, as I said at the start also, that I think intellectually we all understand, we get this thing. It's just
See,
that
no,
we,
no, no.
we
So
find it.
I am not there from that group which want to jaldi और ज्यादा पैसा बनाना है. Okay, मुझे slow और compounding करके पैसा बनाना है. I'm fine with that because I don't want to take undue risk because I have
Right.
seen all those things, all that cycle, and that has shaped my thinking this way. And I feel very comfortable doing that, repeating that process year on year.
Right, 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 right. नहीं वही मैं मतलब मेरा पॉइंट वही था कि बेसिकली people understand generally almost everyone barring a few exception case everyone intellectually understand that this is the right way. The problem is only in the execution. Problem is only you lose the patience in times like say COVID, where the right thing is to bite the red pill as you said, but you do the opposite, right? So no, that's a very, very, very interesting way of explaining the power of long-term investing. And so I'll just move on to the next question now. So next question, I'll just take I'll digress a little bit from investing to the business of investing now. So tell us a little about the history of Aurum Capital. When did you meet Jitin Bhai and how did this idea of teaming up together and providing a high quality research analysis to thousands of investors came to your mind? Also tell us a little more about the journey. If you can share some highs and lows, as in some interesting experience. Because see, I am also probably at a place where you were 10 years, 15 years back. So I'll also get to learn a lot. And plus there are so many other RIAs or RAs who will also probably watch this video, can take a lot of heart and inspiration from your journey as well.
So we started Aurum in 2018, and I met Jitin Bhai first in 2015. So it was not long ago. Okay, what happened that, as I mentioned, that I was conducting those investor education session, and the objective was very simple: to give it back to society. We were not charging a single rupee for that. Okay, and during that process, when your objectives are noble, when your objectives are very clear, that you don't want to earn anything, but you want to give with a very clear heart and sense that you want to give it back to society. Automatically, it happens that you start getting good returns without even demanding for it. That is what I experienced. So I during this journey of giving back, I met very good friends, so very good investors, and I learned in that process. So it was not only that I am sharing, but I also started learning from others. because I was not the only one who was conducting those sessions. There were others who were sharing in those sessions. So during 2015, somebody told me that, and he comes from Pune only, and I have never met him before. So somebody told me that there is some person who is very good in cyclical, and we should invite him to understand cyclical investing. And before that, he was contributing in other forums. So I said, fantastic. I spoke to him, and he was generous enough to come and present in our monthly meet. So that helped me a lot to look at cyclical from a different perspective. And that was the first time he presented on cyclical investing in one of the forums, which became actually very popular later on, which he presented in other forums as well. So that was the basis, and we eventually became friends because our mindset was almost similar, philosophy was similar, the value systems were similar. And during period of 2017, I told him if we would like to start something jointly when we were meeting continuously. He declined that, let's not do something, let's continue to focus on our investment as only. But again in 2018, something has happened, and he said that let's look at this and let's start. Okay, and that is how Aurum Foundation came. The value system was very clear. We want to help or contribute positively to the investing community. We want to be reasonable in price, but we won't compromise on our value systems. We would be focusing only on fundamental research. We'll be buying at a reasonable price. We won't be compromising for short-term gain. So those things remain same, and that is how the journey became, and it was very, very fruitful, as you rightly said. I'm very grateful to our subscribers, to my partner, to the investing community, that we could take that journey very successfully during last more than 6 years now.
Great. So I'm sure, but there would be difficult moments also while in this journey, because sometimes you know what the right thing to do, but probably your subscribers are not ready. They would want you to still. So if you can share a few.
Oh, yeah. There were many actually instances. So when we started in 2018, our focus was value, and our focus was on companies, especially from mid and small cap. And if 2018 we started in August. There was a continuous down cycle for small and mid cap companies. We would not have done significantly well during that period, but we continue to focus on our principles. And during that period, if there were a lot of companies from the financial sectors who are doing very well. So we had a lot of queries: why are we not investing in financial services? Why are we not looking at banks? We said that we are not comfortable with the valuations, we will not buy. So we just kept on pushing it back and continued with the journey. But over a period of time, people realized that what we were saying was making a lot of sense. And today in 2024, when we are very positive on banking and financial services, we have many stocks now. and our investors also during that period became very, very matured. They know that what will be our stand. So most of these questions do not get repeated what we have seen in 2018 or 2019. So that maturity has come again in 2020 when COVID hit, and that bottom was made on 23rd March 2020, if I'm not wrong, if I'm recalling the date correctly. A lot of questions which were there in our investor forum regarding panic which was there, which was set up. It was just 1.5 years of our service. So we said that we should not be too much worried about this, and everything will get resolved ultimately. And if we are buying during this period, it may give significant returns, and if we are selling during this period, we may regret later on. And I hope that in those advice, it would help our investors to make more informed decision rather than taking very arbitrary decision based on what is getting in the momentum during that period. And that we could see later on when they acknowledge after 6 7 months, 8 months, 1 year, 2 year, that what we stated or what we helped, because that was over a period of time we have seen that something which is going down significantly may offer more value rather than getting panicked over there. And that is how this worked.
Great, great. So nice to know about this thing, because, of course, there are many good investment advisors or research analysts who are there in the industry, and all are trying to do their best. But the what really stands out for me when I look at your and Jitin bhai's service is that you will always say from time to time that we have closed our new registrations because we feel that the market is overheated. So when the market is overheated, that is the time when you get most of the new registrations. And closing it at that time requires a lot of integrity and understanding of the long-term nature of this business. So you are basically doing a lot of good thing for the investor community by saying that no, we don't want you to put a new capital at this stage of the market. Maybe wait for some time and wait for the correction. So I really appreciate and like that thing of yours.
Yeah, thank you so much. We did that earlier also, and during this period, actually, we have decided to stop not only new subscriptions but the renewals also of our subscribers. So we are not taking any amount from any of the subscribers. In fact, we have told them that we have given them the path that by December 2025, we are going to close down the service also of research analysts, and we are servicing the existing customers only the way we would have otherwise done. So with the same kind of service quality, we are approaching towards the end date of December 2025.
But if you would like to share why you are closing this, do you have any other plans you want to share? Or I completely agree. As in, it's completely fine with me if you don't want to share at this stage. But whatever little you can share, it would be great.
No, actually, it's there in the public domain. So there are multiple reasons to close down the services. Of course, this was very beneficial in terms of our entire process getting more matured when we are dealing with other people or other people's money in our own way when we are providing the recommendation. So we are very careful in analyzing those stocks or companies. So our entire process of looking at the companies or evaluating the companies has also got matured during this period. And so personally, we benefited a lot. However, there were too many changes which happened in the industry, and we are not able to cope up with those, especially from the regulation side. So I'm not criticizing the regulator. I'm saying that they are doing the right job because that is required. A lot of unscrupulous people are there, and they have to take those stringent measures. However, complying with those on a continuous basis with those changes which are happening, it's very difficult because it takes away our entire attention from research towards the regulatory side of the business, and it takes a lot of our energy, time. So we thought that if we are not able to make positive contributions with our efforts for our investors from who are dependent on us, or who may be paying with an objective that they will be getting positive value from us, if we are not able to justify that, it's better to close down rather than continuing and taking money. So we have decided because of that.
Anything else you want to do apart from this now?
No, absolutely no. Actually, right now there are no plans, nothing we have decided. In fact, we'll continue till December 2025. If something else comes up, of course, we'll inform the community about it. But as of now, there are no plans, and I'm very, very honest with you. There are no plans at all.
Okay. Of course, the investing community will definitely miss this, because we have all had some really good praises for Aurum Capital in terms of the right picks, and even not just right picks, but also cautioning at the right time that this is a time to be cautious about the market and probably take some money out and all. So, but I'm sure you'll definitely find something new to share with us very soon. So speaking about Aurum Capital and how you worked with Jitin bhai, So if my memory serves me well, he was our guest in the 6th episode of Investing Karwa. And he shared a great insight into the confluence of the economic cycle, market cycle, and valuation cycle. And I'm sure you have your views on the same as well. So where are we in these different cycles today as per you?
A very difficult question to answer, Anjit. Economic cycle, market cycle, and business cycle. So, if you look at economic cycle and if your view is long term, because economic cycle, all these cycles have to be looked at it from the long term perspective. Economic cycle for India is absolutely in upward trajectory. There is no doubt about it, and we are on the right path, I believe, because a lot of changes have happened in the economy which are structural changes which are done, and that is going to support our economy over a period of time. So that cycle is definitely on upward trajectory, but we have to have a long term view on that. Regarding market cycle, it's booming, there's no doubt about it. That's it's an upward move. Now third is the business cycle or the valuation cycle. Business cycle for different businesses can be different. So some of the business are excessively heated, so we need to be a little careful over there. Maybe SME, for example, that is one sector we need to be really careful in putting fresh money. If you are invested, nothing like it. If you made money, fantastic, congratulations on that. But if you are thinking about putting fresh money, be little more sensitive, little more careful while doing that, and keep your view from the perspective of longer term horizon. If there is a correction, everything gets corrected. Even if good companies are there, they can also get corrected and they can be available at a lower price. So be ready, prepared mentally in case there is a correction 50, 60, 70, 80% in the prices. You're fine. I'm not predicting that it will happen, but if it happens, you need to have that mental preparation that you are okay with that. In case you are not, take corrective measures in that. Or maybe some of the other sectors, power sector, transformer sector, they are heated. There are opportunities undoubtedly over there, but too much action is there. So I get very scared when these things happen. My antennas are up when these things happen. So I become more careful while evaluating the businesses, the quality and the merit of my investment in those sectors. I'm not saying that they are going to go down, but I'll be more careful in putting my money. While some of the sectors may still offer reasonable valuation. One of the sectors, as I mentioned, was financial services or public sector banks. They are at a reasonable price. Some of these are really at a reasonable price. So we should look at them from long term perspective. There are some more sectors like cement, paper, infra. So these are some of the sectors where still value is there. So even if everything gets corrected, for example, they will also correct. But chances of having a bounce back in sectors where valuation comfort was there will be better than the sectors which are already heated up. If they are at a significantly high valuation, a bounce back in those sectors becomes difficult.
Yeah, so I think this was very important and relevant in terms of the investors as to which industries you are cautious on and which industries, according to you, offer some value. So I think you mentioned very clearly about the SME segment, but apart from SME, any particular industry you would like to say that I'm not asking for any stock names and all, just industry wide, where you think that there is too much euphoria and you would probably avoid that industry. It may continue to do well, that's a different matter, but just you will probably avoid based on the lack of margin of safety there. So if you can just share a few industries.
So as I mentioned, transformer sector or the power sector is one where the valuations have gone up. Though we are invested in some of those companies, putting fresh money, I'll be very careful in that sector, in those companies, and they may continue to do well, as you said, and that's where we continue to be invested over there. There can be value available for an incremental growth. However, if I'm putting fresh money at those valuations, I see a lot of possibility of risk if something goes wrong over there. The corrections can be very, very significant. The stocks have gone up. For example, 500 rupees stock is now trading at 11,000. Okay, so those kind of upside have happened. This is one of the recommended stock that I mentioned without naming it. So 500 rupees we invest recommended nowadays at 11,000. Or another stock which is not recommended, we invested at 100 rupees. Now it is at 7,700 rupees. So 77 bagger in last 3 years. Some of those companies people are not looking at in 2021 because they were going through 8 years of down cycle. Now there is a 3 year of up cycle making up for all those 8 years plus 3 years, that is 11 years period. Absolutely fine if they are growing with you know with the growth in GDP plus some inflation. So if our GDP over that period from for the last 11 years has grown on an average maybe 6-7%, 5-6%, 6%, because COVID period was also there. So 5-6% and another 5-6% of inflation. So 10-12% growth from 2013 to 2024. And if they are making up all this in 3 years, I'll be a little careful while putting fresh money in those companies.
Right. But again, I'll just try to probe you a little more. So power itself is a very, very, very vast sector. So do you think the entire sector is on an elevated level? Maybe there will be degree of overvaluation. Maybe as
true.
you rightly said, the transformers might be in a completely bull or maybe euphoric stage. But there are so many other subsectors in the power sector as well. Do you?
Yeah, true. So it has to be on the merit of individual investor. I'm not painting everything with the same brush. Absolutely not. That's not my intention. I just picked up one, sector and some of the companies from that sector. Still, there can be some companies which are available at, some valuations which make sense. However, putting fresh money in that sector can be challenging. And there can be opportunities in individual companies, subsector, there can be opportunities. We are invested or we have invested fresh money also in some of the companies. However, while putting up that fresh money, we are careful. We know that if there is a down cycle, I'll have to wait. My waiting period can increase significantly. It can't be just 1 year, 2 years. If there is a significant correction, my waiting period can be little longer. However, if I have a valuation comfort in those, and I see a possibility of growth in long term in those companies, and there is a comfort for the management, I may take still a position in those companies. However, it is not a full task kind of industry now, which it was in 2021. Very easy to hit a six when it is a low full toss offered to you, when the entire sector is going through a deep correction or deep pessimism. However, when it is at peak positivity in 2024, I will be very careful in picking up. And I'm not saying that companies will not do well. They may continue to do well. But will investors make money in those sectors? That has to be evaluated very carefully.
Right. So moving on, I think this is probably my favorite question and the most important question for the audience also, wherein I'll just, for the benefit of everyone, I would just ask you to explain your investing process, as in what is your general process of first idea generation? Do you use screeners extensively, or it is more of a quality based or less quantity and more qualitative approach when you start generating ideas? And then how do you go about researching it? How much importance do you put into reading annual reports and con call transcript? How much importance is meeting the management or attending the con call or going for the plant visit? And then finally, how much importance do you think is relevant in doing the scuttlebutt, going into the ground and talking to the dealers, distributors, employees and all? मैंने बहुत सारा क्वेश्चन एक साथ में जंप
बहुत सारे क्वेश्चन हैं एक साथ.
but I think you understood everything and now you can take your own time to explain.
Yeah, it's a very long question with multiple subset of questions within that. So if you look at our investment philosophy or our investment approach, there is no hard and fast way of looking at industries or companies. It can be top down, it can be bottom up, so we are absolutely flexible on that. It can be large cap, it can be mid cap, it can be small cap. Wherever we see value, wherever we see pessimism, wherever we see an opportunity of growth at reasonable price, we definitely consider those companies. So that's a basis. So first thing is very clear that we want to make long-term money, and it happens when we are paying a reasonable valuation rather than excessive valuation. So we are very clear about that. So whether it is industry in 2021, power transmission industry or transformer industry, or hotel industry in 2021, when they were going through a significant pessimism, where you can buy multiple businesses at reasonable valuation, or maybe individual businesses, which is the bottom up approach, wherein you find that companies are struggling for certain reasons. Maybe they have done some acquisition and there are some short term issues in the company, or some short term demand issues there, or some short term headwinds that they are facing, which if we analyze and if we are putting rational thinking, and we believe that there is a reasonable basis that these short term headwinds are not permanent, they are going to resolve, and company is not in on a permanent disruption. There is no survival threat in those companies. We consider them as well. So there are different approaches looking at the companies and sector. And over a period of time, with the experience of my partner and my little experience, we combine that, and we know some of the businesses, how they're done, some of the companies, how they have done, how they have survived, how they have thrived. So we look at all those things. And of course, I said that governance is the basis. The quality of the promoter is very critical in every investment. If some shady company or some shady promoter is making good amount of money for investors, we are fine. We won't like to look at it. We are absolutely fine in avoiding or missing those opportunities. Now, your another question was I missed the third part of the question.
So basically, I meant as in one part was the initial screening. Second part was how do you go about researching, how much importance on reading the annual.
Yeah. So I remember that now. Yeah, sorry. So there's a lot of importance to reading annual reports, a lot of importance to do scuttlebutt, a lot of importance to understand the ecosystem of the companies. But you need to be a little careful while you are dealing with the ecosystem. Okay, what is ecosystem? Ecosystem could include the employees, could include vendors, can include customers, can include auditors, if possible. Some access is possible to auditors. Then auditors, the people, those who are directly or indirectly associated with those companies. Other than, of course, the direct investors, okay, large investors. So I would like to take their view first and get biased. So I would like to avoid including the promoters. So I avoid meeting promoters in a lot of cases. I would rather like to participate in conference calls if they are doing, and understand and question them, or reading their transcripts. What is the management's view over a period of time? If they were saying certain things, how this have happened? If they are continuously promising and not delivering, what is the guarantee that the new promise that they have made will be delivered? Okay, so we look at all those things very diligently, carefully, while we are considering the opportunities. And there are some promoters who will be making promises over a period of time. For example, there was one Chaddi Banyan company in 2012. They said that we'll do this much of revenue, and it was a significant amount of revenue. And another Chaddi Banyan company which was doing very well, okay, which had come little later than this Chaddi Banyan company, but they were doing phenomenally well, and they had done phenomenally well over a period of time. I wouldn't like to name the companies, but the second company made significant promises in 2012. And when I was looking at 2017-18 period, the valuation was, of course, mouth-watering for this Chaddi Banyan company, which made some promises in 2012, and I was not knowing. I was analyzing the new promises that they made, and I started looking at the earlier reports, earlier available annual reports, available media reports of last 5-6 years. I realized that they have made the similar promise in 2012. So there is no point in trusting such companies, and eventually nothing, no money was made. Again, there was a short-term moment in those companies, and eventually they came down. So those kind of things are there, and scuttlebutt is very important, as I said. Understanding the ecosystem of the company is very, very important, very critical. But we need to be little sensible, very careful while we are, reading from the ecosystem. So some of the ecosystem can be biased. So, for example, if I'm talking to an employee and he's saying that this company is very bad, I am an employee, but he might be a disgruntled employee. He might be, leaving the company. So we should not be just dependent only on one input. There can be series of inputs. So we have to look at if what he is saying is matching with other inputs that we are getting, and then some judgment can be made out of it. Some decision can be made out of it.
Yeah. So while you were mentioning about those Chaddi Banyan companies, where one of them basically always used to give you hope by saying that we'll do this. And so I'm reminded of that phrase which Jitin bhai always uses. Those are like, those companies are like permanently pregnant but never delivers. So I was reminded of Jitin bhai, how he used to describe these kind of situations.
Yeah.
So now I have a few more questions, but since we are already approaching 2 hours, and I see a lot of questions on the chat box also. So I'll probably pause my questions for the time being. We'll take up all the audience questions first, and then we'll see how much time we are left with. As in, I'm fine with even going past 2 hours, but depending upon your schedule and all. And I think you traveled a lot yesterday also and came late. So I'll just go to the audience question first.
Yeah.
So Ankit, another Ankit, not me, asked this question. How do you identify bottom, both at market and business cycle? I think this is a very relevant question. Yeah.
Yeah. So timing, the bottom is very, very difficult thing, maybe businesses and market. But if you see, pessimism is getting built for market, I'm talking about. If you have a feeling that you don't want to open your demat account, if you don't want to open your broker site, if you don't want to open and see your portfolio, we are very close to bottom. And if you are feeling that यार ये सब छोड़ के अच्छा था कि अपन वो फिक्स इन्वेस्टमेंट में डालते थे और वहां रिटर्न बन जाता था, ये कहाँ आ गए हम? So that can be very, very close to the bottom. Very important signal. Or in earlier days in 90s, late 90s, I used to do another thing, or maybe early 2000, when online trading was not prevalent, it was not present significantly. So whenever I used to go to broker site, if a lot of people are there, if I had to give some order, I had to stand outside the gate and shout it from there to the sub broker who was taking the orders. ये भैया मेरा order ले ले. तो दिखता था कि इतना पूरा room भरा हुआ है, means we are close to top of the cycle. And on the other hand, if nobody is standing in that room and I am the only one talking to the dealer, then bad days are going on in the market, and we have value available during those periods. Very simple signals, and this can be replaced now with the activity on social media, your WhatsApp, Telegram, Twitter, Facebook, or electronic print media, where if you see a lot of talk about how people have made money yesterday, how investors' wealth have grown, how people are making money in such sectors, how this stock has delivered so much in last 2 months, 3 months, 6 months. You need to be little careful while dealing with those companies and sectors. So bottom will be when everybody would like to stay away. सबकी चड्डी उतर गई और भाग गए वहां से. So that could be the signal for the bottom, and same is applicable for individual companies as well. When nobody is interested, when analysts are frustrated. So another important signal is when you open the con call and you see that company is not doing well for last 2 3 years, and if you look at the transcript and you see that analysts are really frustrated and they are now talking very tough with the management. भैया bottom के नजदीक है अपन, है ना? And on the other hand, if analysts are very happy, lucky going and congratulating management for fantastic numbers, you need to see that you know that cycle is going on well for the company, and how much more upside is possible, that you have to evaluate for those individual businesses.
Yeah, in the recent years, I've also seen some of the analysts even guiding the management how they should run the business rather than so that is also one of the signs.
Yeah, true. It happens actually. I remember one infra company con call, and I tweeted this long time ago.
Yeah.
The analyst, the company management said that we'll be doing this much of growth, and 3 quarters had already gone. Only 1 quarter was remaining. Analyst came, said, "You have already done 3 quarters, this much of numbers, and last quarter, if I add it up, you're not making any growth compared to previous year." And he was right actually in analysis. And then he said that if I look at possibilities, this quarter should be this much, and if I add it up, this much growth should be possible compared to previous quarters. Then management said, "Boss, मैं मेरे business को जानता हूँ, मेरी risk को जानता हूँ, and I feel that this is a reasonable possibility." And that management was very conservative always. They will under commit, under promise, and over deliver kind of management. However, if analysts become very aggressive and putting up their viewpoint about the growth possibilities, there is an issue over there.
Yeah, so this is also one good pattern, as you rightly mentioned, that when the analysts or the investors become more positive about the business than the management, that is also probably a sign of nearing the top, right?
Yeah.
So I'll move to the next question. So Abhishek asks a lot of questions. I'll ask a few of them. How did you transition from the low P era 2 decades back to comparatively higher P era today?
यार सर पी क्या बात नहीं है ना. सी आप तो इंडिविजुअल बिजनेसेस को देखो उस केसेस में, और यू गेट बिजनेसेस एट वेरी चीप वैल्यूएशन, एज आई सेड, व्हेन थिंग्स आर नॉट राइट फॉर दोस बिजनेसेस, वो आते ही है. सो इफ समबडी इज लुकिंग ओनली at IT companies in year 2000, FMCG were completely ignored. They were available at a very decent valuation. And if you suggest somebody to look at FMCG during 2000, अरे बोलेगा क्या पागल है क्या, वो कंपनीज में कोई दम नहीं है. Let's look at IT because it is the charm, it is the talk of the town, the stocks are moving up rapidly. Infosys had gone up almost 10 or 15 times in 6 months. So that kind of activity is there. So nobody is interested in looking something else which is nobody is talking about, and it's not easy. It's not an easy path to follow, because mentally you need to be well prepared about going wrong for some more period, and people will doubt about your investment philosophy. You yourself may have doubt कि भैया ये तो सही बोल रहे थे, हम ही गलत थे, सोच ही नहीं रह पाए हम दूसरे सेक्टर्स के लिए, वहां तो कितना पैसा बन गया. If you start looking at it that way, you'll have a difficulty. But every sector, when it is growing, other sector will be ignored by the market. And as an analyst, as an investor, your job is to identify those sectors which are missed out by the market. And if you believe that there is no permanent disruption, and I using that continuously, there is no permanent disruption, it is not a typewriter industry of 1992, then you can make a lot of money over there.
Right, right. Since you talked about disruption, I'll jump to the disruption related question now. So Ankit again asks this question. How do you identify a disruption or headwind is temporary or permanent in the sector or in the company?
Yeah, so see, you look at the impact of how technology is going to make in that sector, okay, and how qualified is the management to transition from that. For example, some of the ICE related companies versus EV related companies, because there is some disruption over there. Whether it is permanent, not permanent, can be questioned. Whether EV is the permanent thing or something else will come can be another way of looking at it. But ICE per se sector or companies associated with directly associated with the technology related with the engine for ICE may be facing headwind. So you need to be little sensitive about this. And what helps you is a lot of reading. So you read about those sectors, you continuously read and understand what is happening worldwide with that sector, with those companies. Then yeah, you'll be able to make some judgment out of it. And there are some core sectors where people may not like to invest, maybe cyclicality of those natures, but they may offer you value. They may not be or may not be going through an immediate disruption. There can be disruption in long term. For example, cement. Okay, so cement may not have a threat from import because the nature of business is such. Or cement is very regional business. You don't ship or logistic 200-300 kilometers from where the factory is. So there can be opportunities available in that sector, but people may or may not like the sector, or maybe paper industry or infra industries. So those are the things.
Right, 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 right. So I'll move to the next question now. Yeah. So I think this is by Abhishek again. You recently tweeted about the inventory levels in sugar sector companies. Can you elaborate a little more on that as to how it may throw surprises?
Yeah, so sugar industry, if you look at, there were some headwinds which are going on. Okay, the first headwind was related with ethanol production. So before election, government put some restrictions on ethanol production by these companies, and ethanol is one of the very profitable segment for the companies. Because of their own compulsions, government has taken that decision, but it was not going to be permanent, because ultimately, otherwise, if you are not producing enough ethanol, you will not be able to mix with the petroleum products. Your price of importing crude will go up. Your import bills will significantly go up. So you definitely have a reason not to ignore that, because post election it will be reversed, and it got reversed as we stand today. It got reversed. Second is about the sugar inventory level. So sugar inventory level got built up in many companies. If you look at the inventory level of some of the companies, it is equivalent to almost the market cap of the company. So if market cap is 1,000 crore, 600, 700, 800 crores of sugar inventory level is there. So that is available ultimately for sale, because export ban is there. So export ban will be eventually lifted, and if there was already a significant production which was available outside country, and export may have some challenges, the market will have some other reasons coming in. Okay, and that has happened because Brazil had started facing some issues in sugar production. So likely possibility that sugar prices may go up. So if sugar prices may go up, it will not happen only outside India, it may happen in India also. And sugar companies will be allowed eventually to export part of their inventory. So companies can make reasonable profit over there because of that. And it happens actually. If you look at 2017 period for steel companies, uh, uh, and it was going through a down cycle of 4 or 5 years. There was a lot of inventory built up after 2008, and a lot of steel companies, took excessive debt, and this cycle turned completely negative. And then 2017 was a period when a lot of those companies went under NCLT. So a lot of supplies went out, and the remaining companies which were able to, sustain made great money. And then since steel is a global commodity, it is not only India, but it is a global commodity. There can be no import challenges. Something else has happened in China, and China started putting up restrictions on steel production because the quality of air got deteriorated over there. So they started putting up a lot of restrictions. So your pallet companies started performing, steel companies started performing, and that was the bottom of the cycle, 2017. Some reason will come which will give a lot of opportunities for the remaining player. And we don't know as an investor. Hindsight, we may be knowing that okay, China has come again. China's capacities went out, and then Indian companies did well for that. So some reasons may eventually come, and that becomes a reason for making money.
Right. Thanks so much for the elaborate answer on that. So I'll ask a couple of questions from the chat box, which are not basically investment related, but more of a career advice sort of. So first of all, Dheeraj asks that can you give any tips for commerce graduate who want to build career in equity research?
Yeah, so I have a lot of behavioral control, not only for commerce graduate, but for everyone. A lot of behavioral control. Look at it from long-term perspective. Market is not something from everyday perspective, but from a long-term perspective. Invest in quality business. Educate yourself. Learn. So learn a lot of books. Build your capabilities to evaluate the businesses. I may not have invested in steel companies prior to 2017, but I started looking at it differently from 2017 onwards. I had never invested in hotel companies till 2021, and then started learning how those companies work. And as an investor, our advantage is that we do not require to run companies, but just need to understand and identify the parameters which are going to impact the company over a period of time. So identify those parameters, what are those parameters, and then start tracking them. For example, in case of steel companies, the iron ore prices was one of the parameters, or the power sector, power cost could impact the profitability. I'm just taking some examples. So start tracking those, how the trend is over there, and then see how our companies will get impacted because of that, and then understand the industry. So that will help in building the capability. So build capabilities, read a lot, identify yourself, what kind of philosophy you have, what is suitable to your mindset. If you believe that you are not suited for long term, then focus on something else. Build capabilities in something else. If you're not good at evaluating or reading businesses, then develop capabilities in something else, maybe technical. If you feel that you'll be able to do justice over there, do that, but stick to that. Okay, stick to that. Don't change just because the market is changing, because something else is working and you start focusing on that, and then you say that okay, I'll change my base philosophy and start focusing on that. It won't help you.
Yeah, thank you so much. I think that was very useful. So Kamal asks another question related to probably time management. So he said that I was seeing Nitinji's LinkedIn profile and it seemed that he was working full time, even while running Aurum to begin with. So how did you do time management, dividing time between two equally demanding professions?
So this is a passion actually. Equity was always a passion. So if you love something, you will find time. Okay. So when in from year 2000 onwards, when I started focusing on seriously focusing on equity market, I was equally busy in market also. Okay. I was equally busy in my job also, but I was getting time. I was finding time to read, to develop my capabilities.
Got it. So another very specific question. What are the key points that direct us to find a structural change early in the cycle? For example, probably you had identified an export-based transformer company while the power sector didn't even begin. Uh, are there any processes which you follow to identify these kind of trends? You may not need, while I understand which company is being talked about here, but you may choose to not speak about, as in name the company, but just about the process or the pattern which you follow while betting on.
Yes. So as I was saying that you need to identify various parameters which will help you understand. So we were tracking power sector, transmission sector very closely, and it was already going through a down cycle of almost 8 years. So we evaluated sometime in 2018 also those companies. But we concluded that there is some more time left because some of the parameters were not still set. So you identify those parameters. How is the growth happening? How many companies are there? How many are surviving players? What kind of capacities are there? Are there global competitions? What is global demand? How is global companies doing? Because it can be an export opportunity also. Okay. And then sometime in 2021, when COVID happened, and after post-COVID, the remaining players, were also out of the market. So, and as I said, that the market will have its own reason. For steel, maybe China was the reason. For sugar, Brazil can be the reason. For transformer sector, the power consumption by AI companies became a reason. Okay, because they require a lot of power. Nobody thought of it, or you require a lot of storage spaces, and for that again you require power. So again another opportunity which came in. So there can be reasons coming in, but if something is not was in not in in fashion, or was not in demand, there will be an opportunity coming back for that sector, because ultimately you would need transformers. So transformers were old and they required to be replaced, so some opportunities will come, and then stocks will start performing. Similarly, it has happened for hotel. It has happened for real estate sector. We looked at real estate sector post COVID, because it was going through a down cycle for several years. And when we started looking at it, we saw that there is a possibility that people may start looking for bigger houses because of COVID, and because they were staying inside home, and there were a lot of requirement. And personally, I also felt that house has to be bigger, because everybody was working from home. Kids were studying from home, so and you required a lot of furnitures for them. So there is a possibility that people may start. And people were saying that everybody is working from home. The demand for new homes in bigger cities may collapse. But ultimately, it will get reversed, and it got reversed eventually, because you will have to report to the work, and will have to work from office as well. So there can be a combination. That is what we thought, that it is not going to be 100% work from home. It will be a combination of both, because you may require some face-to-face interaction, human interaction. and a combination of both will be a better opportunity, better possibility rather than just working from home. So then demand came back, and it came back very strongly for those companies.
I think this hybrid model which you talked about is this pattern is very clear in many industries. People thought IC will be extinct and EV will be there. Now there is an hybrid which is in the form of gas, which is doing even better. Right.
Yes, very right.
Similarly, as you rightly said regarding work from home and office, the hybrid model is working more where whenever I talk to my friends, there are many people who are actually going 2, 3 days to the office and rest of the days we are working from home. So I think I've covered probably all the questions on the chat box. Due to the paucity of time, I'll just ask one last question to you, Nitinji. So who have been your top 1 or 2 investors in India and 1 or 2 investors in outside India who have inspired you a lot? And more importantly, what would you like to share about them that can inspire others also who will probably have people who are watching this live or people who will watch the recording later?
It's a very difficult question because you are putting me in a spot. If I start naming a few and miss others, it won't justify. But still taking that risk, let me say that, since our focus is completely Indian market, so I would like to focus on Indian investors because outside India we know a lot of investors. People we name very easily: Charlie Munger or Warren Buffett, or Benjamin Graham, or I'm talking from the fundamental and value side, but those are the well-known names. But because for us the environment which is more relevant is Indian equity market, because that's where we are investing. A lot of investors who inspired me, a lot of them. Uh, I would like to start with Parag Parikh sir, an amazing book that he has written on value investing. uh, he was the first one who started talking about importance of behavioral finance. A very very nice book that he has written, and some of the videos are available on Parag Parikh Mutual Fund website, also on YouTube also. So those can be looked at. Amazing person, and very very value driven. That entire setup is amazing. So that's one I would definitely highlight. And there are many actually. I learned a lot from my partner Niteen, especially about cyclical investing. So I have significant respect for the work that he has done, and again, sharing with people that work, that mentality, that is something that I appreciate a lot. Otherwise, I would not have been investing in some of those companies and made money out there. Then there are many others actually. Uh, 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 they may or may not be in public domain, as much as they should be. Like Nimish Bhai, you talked about. He is not very vocal or not available in public domain, but amazing understanding, because I interacted with him. I got that opportunity when I was in Flame, and I saw how he looks at businesses, how he looks at risk, as very very clear in his mind, and his understanding about the numbers is superb. It's mind blowing. And there are many other investors who are very vocal, or who were very vocal earlier. One of them is late Rakesh Jhunjhunwala ji, who is no more there, but the way he used to communicate his point of view, and his ability to his foresight about what could happen with the market was unparalleled. The way he talked about the strength in the equity market, the strength of common investors, which will unfold and which we could see now getting unfold, which he could foresee several years ago, again has to be appreciated and learned from. And that again focuses on the long term perspective rather than getting entangled in small day to day activities.
No, thank you so much, Nitinji. That was very, very, very heartening to know. And I just want to, before we end the session, as we have probably covered at least 2 hours, I'll just share one thing is that just like you get motivated and inspired from people you have just mentioned, like Mr. Rakesh Junjunwala, Nimish, and most importantly, Mr. Parag Parikji. There are so many investors who also look up to people like you because, see, all these great investors, they are probably not so approachable. And while there are many works of them available on the public domain, but on a regular basis, they are not approachable. But people like you who have say 30 years of experience in the market, the kind of details or the kind of content you put out on social media, those are very, very, very useful source for us who have much lesser knowledge or experience in the market. And that itself is a source of inspiration for people like us who would probably learn from your experience and try to see if we can go somewhere in that journey as well. So thank
That's
you.
very kind of you. I don't know that if I deserve that. While doing or sharing, I have my own benefit because I learned in that entire process. I get a lot of inputs during those process, and that has happened actually from 2008 onwards. When I shared my first presentation about how to invest in equity market, I remember that I was in L&T in those days, and the first time I did that presentation, somebody asked me, I know how do you sell. Okay, and that triggered a lot of thoughts because I had not covered that because I was talking about how to buy shares in equity market. I did not cover extensively how to sell.
Right.
So it was again an opportunity to learn, and over a period of time you cover that, you learn from others. I just cited one example. There are many actually. When you share, you also learn from others experiences.
Right. So thank you so much, Nitinji, for sharing your valuable time and experience with us. We all had a wonderful time listening to you. And as always, we'll put the recording as soon as possible, both on our Mission Smile platform and also on our YouTube channel so that the investing community at large can also learn a lot from this. So that brings us to the end of the 21st episode of Investing Karma. Thank you so much once again, Nitinji, and thank you so much everyone for being a patient listener and asking some really good question. Hope you had a very good time and have a nice weekend.
Thank you so much, Ankit, for inviting, and thank you all for attending this. I appreciate this, and I know that you are doing a wonderful job with Mission Smile, and I also look forward for the interaction that you do, and I look at some of those videos that you share on YouTube. There's always an opportunity to learn from others' experiences. Thank you so much.
Thank you so much, everyone. Thank you. Bye.
Bye.